Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu, 4 o'clock in New York on Monday, February 29th, 2016, and we're looking at the Dow Jones Industrial Average after trading strongly and solidly higher through the morning session, actually closed lower on the day, selling off as it goes into the close. You're looking at settlement right now as we're getting the last trades of the day. Triple digits again. We're currently down about 100 points, 102, 103 in that area at 16,536 and change. Of course, our Standard and Poor's are also trading lower on the day, down about 11 points or 0.6% at 1930, 1931 in that area. Now, of course, we're long gold. We were looking for a place to position ourselves in the equities markets vis-a-vis the E-mini. And I really had some difficulty the other day actually pulling the trigger on that trade. And so I wanted to spend a couple of moments and really discuss what was going through our mind as we looked at really the technical aspects of the market as they trade. And the first thing that we're going to talk about is this candle type that came in on Friday. We talked about it a little bit, and we talked about the fact that I certainly wanted to see if we could see this market break above this 61% retracement, which is sitting at roughly, a 1933, 1938, excuse me. And what we saw, though, was we did have, and this, of course, would have been Thursday of last week. So what we saw on Thursday of last week, of course, was this nice move back up and solidly above this particular level. Of course, the key was that going to be a sustainable area in which we could see this market move to? And we talked about the fact that the bullish scenario, or on the bullish side of the fence, was the fact that we had certainly moved up and traded above this, and we would look to see if this particular area now becomes support as opposed to it being resistance. But the way that it came off of these highs, and you can see these highs come in and they match the 50% retracement. And of course, this retracement that we're talking about is all about that August meltdown last year. But we got that shooting star. And my point with the shooting star is that one candle certainly does not make up a pattern, but in terms of single candlestick types, the umbrella lines are very significant when found at certain areas in the market, meaning after a defined uptrend or a defined downtrend in the market. So the fact that we got this shooting star and that today is followed by a confirming candle, we get this 3-day pattern really in which we have a shooting star confirmation. And we're also trading, which is to me what's critically important, below this point at 1938. So we're going to sit on the sidelines. Obviously, it's not time to get long. We're looking also at the dollar and crude oil. And crude oil, interestingly enough, was up about 3%, well over $33, almost at $34 per barrel. And what's interesting is even with that dramatic rise in crude oil, we still had some really downside pressure that was found within the equities markets. And so that when we look at, for example, the monthly chart, you can see that the open and the close of February are pretty much identical. Now, look at the low that it made, and that's right above $25 per barrel. But the fact that it closed like this with such a strong doji, to me, is a signal that we could be looking at some sort of potential bottom or support within the crude oil market. We're going to sit on the sidelines. We've got our gold position working for us. We'll have to see as the dust settles as to if this pressure that we saw in the equities markets is something that will continue on through next month in March, or if we'll see it move back up over that support area at 1938. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.